even when the gold price rises, I mean, there's still always consistently underperformers, and there's, companies that outperform greatly. And it's not just the gold price that does that. So there's a huge opportunity for actual stock selection in this space.
Welcome viewers to our gold investment discussion for one-to-one mining investment Americas. I'm very pleased to be joined by a panel of mining and investment experts with a wealth of experience in raising capital, developing mining projects, and generating significant returns from identifying investment projects of real quality. So introducing the panel, it's my pleasure to welcome Coille van Alphen, who's Senior Analyst at Equinox Partners, Adrian Day, who is the Chairman and CEO of Adrian Day Asset Management, Gordon Stothart, CEO of IAMGOLD, and Matt Geiger, who's the Portfolio Manager at MJG Capital. Welcome, everyone. Let's get right started onto this discussion then. I'd like to start by asking the panel, what's their views on the gold price moves towards the end of this year, and what are some of the macro factors that you see as the biggest influences on where the gold price could be headed? Why don't we start off, Coille? Could you kick us off, please?
Sure. I think in the near term, I think it's fair to say there's a lot of volatility and uncertainty coming into an election in the U.S. I could say, being in the U.S., it's pretty choppy. So I think there's probably a lot of capital on the sidelines, sort of waiting to see how things play out until November 3rd, and potentially if it's contested, much longer than that. So, and then obviously stimulus package. So there's a lot of question marks still there. So until we have some clarity, my view is that it's going to trade roughly sideways, probably until the end of the year.
Yeah. And then you think perhaps once that clarity, if even it becomes clearer next year, that we might start to see that the gold price peter out a little bit?
I mean, I look at sort of obviously physical ETF levels are all-time highs with 3,900 tons. But if you look at that number and sort of break it down, only about half of that is North American holdings, and historically that number has been about 2/3. So if I think that the North Americans are going to come to the gold party, there's still more physical buying to be had on this on the North American side of the equation. So I think that supports the gold price, just regardless of everything else, whether it's stimulus and whether the printing presses continue on forever. I think there's probably still some support just from the physical buying.
Yep. Adrian, what's your sort of view here on some of these macro factors that are dictating where the price might be headed?
Well, I do agree. It might seem a little strange to us that ahead of the election, gold is so flat. I don't think anyone is taking gold out of their Swiss bank vault and selling it, but I think there's a lot of Americans who just want to go to cash ahead of the election. Just have cash and see what happens. And that includes, the gold ETFs, I think, and certainly it includes the gold stocks. That's one factor. The other factor, I think, why we've had such a sort of long sideways downward, correction is, I think the correction or the pullback was delayed a long time. I mean, I was thinking in May or even the end of April, I was thinking in May we should have a correction, and in June we should have a correction. And gold just went up so far for much longer than a lot of people thought it would. And so in that sort of circumstance, you expect a pullback, I think. You expect the pullback to last a little longer. So I agree that we're probably going to have this choppy sideways until the election. But after that, we can talk about a lot of things, but the one fundamental factor that's been driving gold, and I think will continue to drive gold, is monetary policy around the world. And I'll put policy in quotes because I don't really think, I don't really think that certainly the Federal Reserve, I don't really think they know what they're doing, frankly. And that's a strong statement. But so I think if we get a sweep, either by the Democrats or by the Republicans, meaning that the presidency and the Senate is in the hands of the same party, we're going to continue to see spending. We'll probably see more under the Democrats, and we'll certainly see different priorities depending on which party's in. But if you have a sweep of either party, you're going to continue to get stimulus from spending from the government. It's going to be unfunded spending, and the Federal Reserve is going to continue to accommodate that unfunded spending. And that is enormously bullish for gold. So once the election we have a little bit of clarity on that, I think gold is going to resume its upward move.
Right, excellent. Matt, what's your take on that as well? Do you agree with some of the sentiments there around petering out, and then after the election, things picking up?
Well, I think a better question to ask here is what happens with the U.S. dollar. If you want to try to predict the gold direction, that's kind of the key indicator that I'm looking at the moment. And to be clear, I think a few of us on this panel, we're stock pickers first, bottom up security analysts and not macro forecasters. So I want to make that clear, but I still want to have a sense of where we are in the general market. So I'm watching the U.S. dollar. We've obviously had back-to-back very strong years for the gold price, but the years are actually quite different. In 2019, the gold rose in tandem with the U.S. dollar. It was a very strong year for both of these currencies. And in Q4 of 2019, the correlation between gold and the U.S. dollar was a positive 0.74. So investors in either of these asset classes were doing well. The script has really flipped this year. Over the past 120 days, I believe the gold price has a negative 0.92 correlation with the U.S. dollar. So it's really joined the rest of the commodity complex and benefiting when the dollar is weak and getting hurt when the dollar performs well. And so I think that's important to keep in mind. Looking at a potential Biden or Trump presidency, I think on the Biden front, should he win, that would likely be bearish for the U.S. dollar. I think that's the consensus that's forming in the market here. He'd have a much less combative trade policy, which, as we know, over the past few years has strengthened the U.S. dollar. And I think additionally, he'll be more willing to embrace modern monetary theory, or at least that will be the perception. And as Adrian said, these unsustainable debts without revenue offsets, is going to come home to roost at some point. And then I finally note that the U.S. stock market has outperformed both the emerging and international markets for years now. And I think that move is getting long in the tooth. It's probably long in the tooth whether Biden or Trump wins, but I just think perception-wise, should a Joe Biden presidency come to pass, we'll likely see the U.S. market start to perform more in tandem with their counterparts around the world. I think that will be bearish for the U.S. dollar for the medium to long term. Okay, excellent. Yep, looking at the dollar there. Gordon, let's bring you in as the mining company on the panel here. It's a good time to be a gold developer producer, presumably. And what's your thoughts on gold price moves this year?
Yeah, I mean, definitely, it's certainly been a good time watching the revenue spike up. I think it's really intriguing for us looking forward. What it really has done for us is really create the foundation for us to launch into our major development project at Coille. I think, especially in the situation we're in now, where we're embarking on this major build, we really tend to be very, very extremely conservative with our assessment of gold price by necessity. So, I mean, we're still doing reserves at $1,200, and we're doing our planning for next year, I think, at $1,600. So we're obviously much more hurt to the downside. What we do look at, and I'm reading, I guess, a lot of the same news as everybody else. It'll be interesting to see what the volatility. I concur. I think there's a lot of money sitting on the sidelines right now, trying to figure out. I think a lot of people, not just news agencies, got surprised in 2016. Everybody had made the call one way, and we're a little bit shocked. So once bitten, twice shy. People are holding back to see which way it goes. I mean, the stuff I'm reading is sort of showing multiple different scenarios, but they all include stimulus right now, which can't be bad in the medium term for the price of gold. And we'll see where it goes. And I really do agree with Matt. It's really intriguing to watch U.S. dollar correlations or inverse correlations, if you will, versus the gold price over the past while. The only time it seems to crash is when there is a 1 or 2 day crash and everybody's running to cash, and you see that short-term dip in the gold price, and then it claws its way back. I guess what I'm feeling happy by, I mean, we did all our planning for this year at 1,300, 1,350, is it nicely rode up. As Adrian pointed out, it peaked and came back down, but it by no means crashed. I mean, it's off 5%, 5-7%, something like that. That's not a major adjustment, and it's really been trading extremely, for me a little bit anyways, within a pretty tight band here now for the past couple of months. So to me, that's an indication people are sitting and waiting to see which way things jump.
Yep.
Can I just jump in? Another thing that's really interesting to me, at any rate, over the last couple of weeks, is every day you see gold decline reasonably sharply, either in Asia or in Europe or in America, and the next market to open immediately brings it back up. That again, that just support, and whether it drops in Asia, Europe, or America changes every day. But it always comes back in the next market, which says just emphasizes there's money on the sidelines waiting.
Yep, absolutely. Okay, Gordon, I want to just jump back to something you were saying about your planning, and of course it's great to have the cash coming in if you've been planning at sort of $1,300 to $1,500. But does that then change what your shareholders are expecting of you in the near term? Are they suddenly saying, hey, look, you've got this really favorable gold price, are you looking now to sort of return more dividends? Are they saying, can you put this into new projects and sort of build out your construction phases? What's the shareholder feedback on that improved gold price environment?
Well, leading into the announcement to build Coille in July, we've spent a lot of effort in making sure we've got a very, very solid balance sheet, and we've done that for a long, long period of time. I think what we're hearing from our shareholders, everybody's comfortable with that. We don't have to go out and do any kind of financing in order to be able to execute on this project. Right at the end, or I guess in August, September, we were able to roll over our bond and push it out a few more years. So we've really sort of taken care of all the financing aspects to the project. And, I think our shareholders understand completely when we're saying we're really safeguarding this balance sheet for the next year or so as we get into executing on this project to demonstrate that we can execute well. That being said, there certainly is pressure on dividends. A lot of our peers who aren't building right now and who really are getting some nice returns on their gold production have declared or upped their dividends over the past while. It's interesting. As I said, we're planning on a lower price, but we certainly do the analyses at higher prices. I mean, we do the analysis at spot price. I know it's a decision we're going to have to continue to revisit on a quarterly basis as long as those high prices are sustained. And as we get further into the execution of the project and the variability for us to be able to reach conclusion with it successfully is diminished over time as we execute. I think, if sustained higher gold prices, even if they're where they are right now, by the Q1 next year, Q2 next year, we're going to have to look really, really hard at rewarding our shareholders for their patience, for sure.
I think that's a really important point. And we talk about gold prices and where they're going, but even if the gold price settled at 1,700, I mean, the free cash flow profiles that, particularly the intermediate space, I mean, I think they're yielding 10% for 2020. I mean, those are good numbers. I mean, I think we're, the forest from the trees a little bit in terms of the strength of their balance sheets and just the sheer free cash flow they're going to generate, and the cash is going to accumulate to the balance sheet is different this time around than the previous time. So, I mean, 2,000 or 2,500 or 3,000 is a great number, but even sort of
Yeah.
hovering around where we are, I mean, it's top quartile free cash flow out of any sector. So I think that's worth doing.
I mean, we've not just us, but I think the whole industry, we spent a lot of time on our cost profiles over the past several years and pulling those in line. I haven't heard of many people going too crazy yet with the high prices, certainly compared to maybe what happened in the late 2000s. The last time the prices spiked up, people were going after maybe some questionable projects. For us right now, I think that sentiment still exists in the marketplace. People are continuing to chase costs. What will be intriguing over the medium term, as we look at people's reserve profiles, which have been sort of decimated over the past while, start to get a little more incipient, the end of the road. It'll be interesting to see what people do with their cutoff grades, which will directly impact their costs.
Yep. Okay. We can delve into more of that in a bit
Yeah.
as well. So that kind of what you put in there was leading to my next point around the general health of the precious metal sector. Obviously, things are looking a lot better than they were perhaps in the last cycle. But could the buy side just give us an insight as to why that might be from your perspective, and also, do you then feel that there's some of this capital that we've just discussed that's sitting on the sidelines waiting for a bit more clarity in the markets? Do you think that capital is then going to come into mining, gold mining equities? Does anyone want to take that one?
Yeah, I can jump in here. I mean, I will say it's far too early for celebration. I think the larger players have been well behaved so far in this cycle, but we're still early with potentially multiple years to go here. So positive signs so far, and we haven't seen kind of the hallmarks of the tops of the cycle that we generally do, which is large acquisitions at high prices fueled by debt. Right now, most of the acquisitions have either been cash or share based at the moment, which I think is positive for the space. Secondly, would be the concept of empire building. Once you get towards the top of markets, you'll generally see companies growing for growth's sake, taking over other assets, other companies, just so they can have a bigger production profile and more ounces in reserve, but not really gaining anything from an operational or strategic standpoint. And then additionally, and I think what Gord just touched on is very important, but at the moment we have companies focused on high quality projects. And they're plugging in $1,200 gold into their models, at least some of the more credible players here. And that, is definitely positive. That errs on the side of conservatism. In the last cycle, though, and I worry as the cycle progresses and the animal spirits get a little bit more out of hand, that the larger companies will start focusing on these very large, low margin, high capital intensity projects. That sure, if gold continues to move higher and copper continues to move higher, then they should do great. But as a steward of capital, I don't think your job is to predict metal prices by any respect. So I think the industry at large would be well served if these companies continue to focus on high margin projects that work extremely well at current metal prices, and even would be profitable if metal prices went down 15 or 20%. Like Colleen said, $1,700 gold's not a bad price. Like let's not get too greedy. I think will be in the best interest of everybody and the longevity of this bull market for companies to stay disciplined. So far so good, but whether that continues remains to be seen.
Yeah, I
Adrian,
I agree with Matt there. I agree with what everyone said, actually. But yeah, I'm a cynic. I think eventually when we have 2,000 and 2,200 gold for any sustained period, as Matt put it, the animal spirits will come out again. But for now, there's no question there's a discipline among the seniors. And that's a very good thing. I mean, obviously, after 2012, we had a rotation in management. That's a polite way of putting it. And so we've got a lot of new management in. We've got to focus on, profitable ounces as opposed to growth for growth's sake. The other thing that we must recognize, I mean, Colleen said 1,700 is not a bad price. Absolutely. But the other part, and that's true, but the other part of that is the cost. you know, oil or energy represents over 30% of the cost of running mines on average. The oil price is $40 compared with 2011-12 when it was 130, 140, and even peaked at $160 an ounce. That's night and day. The second major cost input of running a mine is the local costs. Everything from your workers on site to, you know, local supplies and everything else. And that's partly, largely determined by the currency. Look at what we call the commodity currencies, the Canadian dollar, the Australian dollar. They are way down from where they were in 2000, or significantly down, I should say, significantly lower from where they were in 2011, 2012. So the cost side of the equation is also very, very favorable for gold mining companies. And I would say that if you're a major miner and you can't make money in this environment, there's going to be a problem, because when gold's at 2,200 and 2,500, I am willing to bet that oil won't be at 40 and that commodity currencies won't be where they are today. So costs will have risen dramatically.
Well, you're seeing that already. I mean, there's a bit of cost creep sort of from 2019 to 2020 in terms of
absolutely, yeah.
Right? I mean, they're up about 10%, but which makes sense because I think there's a lot of delayed purchases or development that needed to happen that are, now that there's some excess cash, it's like, well, we need to catch up with what we should have maybe done 18 months ago or 12 months ago. But I think being able to hold the line where we are and show there's discipline this time around is sort of what's going to help generalists, along with ESG. I mean, we haven't talked about it at all, but it's obviously a very large trend in other sectors that, you know, the mining sectors coming around to. So
I would definitely bring up ESG perhaps in a minute, but let's keep on just on the cost point. Gordon, do you have any other points to add from your side around cost creep? How have you been experiencing that or dealing with that?
Well, I mean, 2020 is an outlier year for many, many, many different reasons, and you know, sort of filtering out what are the effects of the COVID pandemic from regular effects are there. You know, there certainly are other factors involved for us. Our current major production assets, Suriname with the Rosabelle mine, in Burkina Faso with Essakane, we're seeing they're mature operations. You know, we have marginal opportunities to go back and rejig their cost profiles. We can make marginal improvements, but mines are typically designed to have cost creep over time. I mean, if you do proper engineering, that is typically an outcome of any mine. If you haven't built anything new to sort of reset the bar with respect to cost over time, if you've been running out your assets, I would expect to see that cost creep. I think, you know, again, sort of circling back to what's happened on the exploration side, it'll be intriguing to see where it goes, whether there's sort of a reset in the cost curve, sort of given the history since 2013 for the group as a whole, and understanding that there are a few opportunities to go back and reset with fresh operations that can generate fresh cash. Like every operation, you know, we've obviously been looking for the high grade over the past 5 or 6 years, 7 or 8 years, and using that to sustain the lower cost profiles. What happens when it hockey sticks up like this? It'll be interesting to see where it goes. You know, we are looking for innovative improvements, but again, they'll tend to be marginal. You're not going to see that step change downward, and we're sort of fighting it on all fronts right now. And I think, you know, Adrian's comments with respect to fuel price, energy inputs of any kind, and certainly labor. We've seen the you know, the currency benefits, but the one piece about labor is nobody comes and asks for a wage reduction. You've been going on for years and years and years. You know, those wages, at least in current currency terms, creep upwards, and you got to deal with it.
Yep. Okay. So let's move on to some of the investment strategies in this in the current market now. Coille, maybe you could give us a little take on how you cut through the sort of perceived noise of a gold bull market, and how you identify companies that that are attractive for your fund, and how you sort of filter through the volume of companies that we have there, particularly in the junior space as well as mid-tier.
I think what's probably important to start with, Equinox is a hedge fund that's sort of geared towards better business value investing. So we're focused on value, but not just cheap for the sake of being cheap. So there's a different, I guess, we're not high frequency traders. I mean, we're looking for long-term value creation over a 5-year hold period. So we may look a little different than others. So when I look at particularly given the amount of cash flow that's going to be generated, to me, management teams and boards are probably the number one thing that I look at in terms of quality. I think asset allocation and a strong board are my first consideration when I look at companies, and then I look at the assets. But I start with the management team and sort of their track record. The board, do they own shares? Are they invested in this company? Those kinds of things to me are imperative to get right. Otherwise, the rest of it just doesn't work.
Yep, certainly. But we hear management team mentioned a lot, and of course it makes perfect sense. But what do you actually ask of them? What as a hedge fund, what are you scrutinizing for or looking for within that, within the management team? Certain characteristics.
Well, by and large, management teams have not. Some of them have turned over, but a lot of the management teams are the same management teams that have been in place for the last 10 years. So you have the ability to go back and look at how they've behaved before and how they've operated in their decisions, potentially what's changed or what hasn't changed, and sort of ownership of their companies, and the board's ownership of companies is, to me, dictates a lot of what it's human behavior of how they're going to behave going forward. And if you own a lot of the company, you care about its share price. So that's what we tend to focus on primarily, not primarily, but it's first order.
Yep, certainly. And within the companies that you look at, you look across the whole spectrum from junior, earlier stage players right up to majors.
Yes, I'm fortunate that from $10 million to the barracks of the world are sort of the space, but when you tend to have a value filter, you end up in the intermediate space because they're trading at cheaper cash flows, and it just makes, from the value perspective, makes more sense. But yeah, I think also the ability on that management piece, I travel around the world to go see assets. So the ability to go to Burkina Faso and go meet the GM at a mine is, for me, very helpful, because I understand, how that person is operating and how they think about running a mine, which is very different than meeting the CEO at a conference. So it's a different level of view. And then, being able to go see the local community and how they manage CSR, because CSR is not managed the same by all companies. Understanding all those factors, to me, sort of helps put a circle around sort of my confidence in the management team, and are they making the right decisions?
Yeah, certainly a lengthy due diligence process there.
Yes.
We'll come on to some of those CSR under the ESG point that you raised again in a bit. Matt, take us through some of your triggers, if you like, or some of the areas where you look to sort of remove companies perhaps from your crosshairs as well.
Sure. So for the MJG fund, I would say we're much further upstream than either Adrian at Adrian Day Asset Management or Coille at Equinox Partners. At the moment, roughly 75% of our portfolio is either in the prospect generation, exploration, or development sectors there. So we're pre-cash flow for close to 75% of our names. And we only have one producing miner in the portfolio, believe it or not. The remaining 25% of the portfolio that's cash flowing are primarily royalty companies, along with a couple agriculture plays. So with that said, I think your original question You know, when you said cut through the noise is a very good way to put it. Because right now I can confirm that the Vancouver and the Perth paper mills are up and running. And it really does seem like there's a new gold or silver focused junior being birthed every 12 hours. And yeah, it must be exciting for the bankers, but for investors in the space, the quality names are getting diluted more and more, right? So I think we've seen marginal projects that have been sitting in the cupboard, you know, sitting on the shelf for years without being touched, now being brought out and marketed as world-class assets. You know, we have management teams that just a few years ago were engaged in crypto or cannabis ventures that are now coming out and calling themselves seasoned mining veterans. And so I think investors just need to be very, very careful. And kind of to Coille's point here, take that bottom-up approach. Focus on the people first. You know, look at a few different factors. How much skin in the game does management have, especially if they're a junior and kind of on the smaller side from a market cap perspective? You absolutely want to see double-digit skin in the game, if not much higher than that. You know, what is their average cost basis, right? Even a management team that has good skin in the game, if there's a 10x uplift on their cost basis to where you're getting in, that's not quite as attractive. But if you can get in at a similar level to them, or a small uplift, then you're much better aligned with that team. Also look at how do they get their shares? Do they put a significant amount of their net worth in? Were all their shares issued as options and they don't have much skin in the game? All of these are very relevant to both look at the people and their incentivization. And then, also, as I mentioned earlier in this conversation, focus on assets that make sense at current, prevailing metal prices, and at metal prices even below that. Let's stay away from these optionality plays. It's easy to bet on gold going to $3,000 or $4,000, but I think as an investor, it's better to focus on projects that work at the metal price. If gold does go up to our wildest fantasies here, then great. That's cherry. That's icing on the cake for current holdings. But stay disciplined with the assets you're willing to look at. And then finally, very quickly, if you're focused on the junior niche of the market, especially if you're a retail investor that doesn't have the wherewithal to participate in private placements, be very careful looking at the company's working capital position, especially how many different catalysts they're going to be able to achieve before the next financing. And it's not worth putting money into the open market if you have a serial diluter, or the company's going to have to come back to market and raise in 3 months and 6 months. If you're going to put money in a company that needs to raise in the next 12 or 18 months, make sure they have a drill program coming up. Make sure they have a PEA coming up. Make sure they have a major permit in the works. I think these are all important, especially if you're not playing on the level playing field with some Canadian investors or some institutional investors that do have the ability to participate in private placements. So be careful of that.
Sure, absolutely. Okay. Adrian, have you got something to add to that?
Of course. Well, Matt, I mean, you took a lot of words out of my mouth, and I know one thing you didn't say that I know you also think about is with juniors. It's important that investors look at when the warrants are expiring, because typically investors wait to the last minute to exercise their warrants. And if you've got an in-the-money warrant, you're going to get a flood of shares coming out. And often what happens is shareholders sell the very stock that they're exercising in order to raise capital to exercise the warrants. So that's an important thing. Like Equinox, like MJG, we are value investors. So, I look bottom up at individual companies, although I do have a macro view, but, we look at individual companies. And like Equinox and like MJG, well, perhaps not like MJG, but I was going to say we're market cap agnostic, but certainly like both of them, we invest in juniors as well as the other sector of the market. And the things I look for are a little bit different. Obviously, there's different things you look for in a major multi-mine producer than you look for in a small junior. There's different things, but the one thing I look for, and the one thing that is critical, as Colleen said, for every single company I look at, is management. And the beauty of the gold space is that it's a pretty small space. So you can get to know the CEOs of most companies, even of the major mining companies. And that's not true. The lower down the scale you go, the more junior, then the more time I want to spend with management. And, you know, Colleen said something that was really resonated with me. I'm not a geologist. Maybe I shouldn't admit that, but I will. When I go on a mining trip, I'm not looking at the rocks. I'm looking at the people and how are they interacting with the local people. And that to me is absolutely critical. And by observing, you can tell an awful lot in 48 hours on site. You know, if you're at a junior, an exploration, you know, do the chefs, the cooks, the Mexican cooks come out and hug the CEO when he arrives? Or is everybody kind of going into a corner and turning their back? I don't turn in their back, you know, but just hiding so that he won't see them. These things are critical. How does a guy act when he's in a restaurant? That's important. You know, is he an arrogant SOB, or is he because if he is, he's not going to get on in the, you know, community, but community relations, which are so important. So management to me is number one, whether you're a big company or a small company. And, you know, people say to me, well, what difference does the CEO make to a big company? It makes one heck of a big difference. You only have to look at Barrick and when Bristow took over to see that. The other thing that's important for me at all levels is balance sheet. And Matt really did a good job of taking us through, you know, what that means for an exploration company that doesn't have revenue. An exploration company that doesn't have revenue has to raise money, and 9 times out of 10, they have to do it through equity raises at some point. Now, prospect generators, which Matt talked about, try to limit their equity raises and their dilution by bringing in partners who spend money and sometimes, you know, give a little bit of money to the company, you know, who's feeding the project. But a company without exploration has to raise capital, has to dilute. What you need to look at is what is the history of dilution. And it's funny, I just looked at some of this yesterday for some particular reason. So I have the numbers in mind. There are companies who in 10 years, without a fundamental transformation, have gone from 5 million shares out to 197 million shares out. Now, that means that the company has to increase its value by, is that 20? No, it's 40-fold. They have to increase their value 40-fold for each share to still be worth the same. That's a very difficult thing to do. And so look at the history of dilution, because the company that has typically raised capital every single year is going to continue raising capital every single year.
I think that's particularly important to think about in the context of how long it takes to develop an asset. I mean, this is probably one unique thing that's different than any other sector, is that I don't know what the exact year numbers is, but 10 years, Bristol will tell you it's 20 years from sort of start to finish of first gold. So it doesn't, I mean, dilution over a 20-year period certainly adds up if that's really what the number is before you're going to see first cash flow. I mean, Coille is probably a decent example of that. I mean, when you acquired that in 2014?
2012.
And it's,
you know, the discovery drill hole was, I think, 2009 by the junior that had it. And it will be in production in 2023. So, you know, that's, like you say, 14 years from initial drill hole to production. That's a long time.
Yeah.
Yep, certainly. Okay, well, that's an interesting point to end on in terms of that is part of the discussion in terms of acquisitions and then creating value through M&A. So I'd like to jump over to that as a topic for the panel now. What's firstly the shareholder view towards M&A, and then Gordon, we can perhaps touch on some of your thoughts on best practice with regards to that and what's gone on as well. Does anyone want to jump in? Coille, we were talking previously about M&A as a point to raise here. What's your thoughts on M&A perhaps picking up at this point?
I think there probably should be more M&A at this point in the cycle. My view is when you look at how much capital has been raised this year, excluding the seniors, I mean, it's a little over $2 billion US this year, which is the last time we hit this level was 2012. So you look at those numbers and it's telling you that investors want companies to do exploration. And I don't think there's enough of an overlap yet in terms of value creation from the juniors that are finally being rewarded for drill holes. And sort of the producers, I don't think there's enough overlap yet in terms of wanting to have a deal. There's not enough gains on each side yet to sort of have that deal crystallize. So that's my view is that it's coming, just not yet.
Yeah, Adam, to jump in on that point, I think the M&A market was rocking and rolling, you could say, before this coronavirus induced panic. I think most of the panelists would agree with that. Maybe the pace of deals could have been a little bit quicker. But because of the virus, it's been really a quiet, 6 or 7 months. I'd say the only deal of particular substance was the recent Northern Star Saracen merger that now creates a $14 billion Aussie integrated producer. And that was, I think most in the industry like that deal as well. There were clear operational synergies from those two companies combining. So as an objective observer, but that wants the gold industry to be healthy, I give the thumbs up to that deal for sure. But I think otherwise, there's two things that have kind of slowed the M&A environment. The first is the lack of travel. A lot of the deals that have been done in the past 6 or 7 months have been, shoot from the hip, minimal due diligence types of deals. But for these larger companies that really want to approach things properly, they want to spend months, in some cases over a year, doing diligence on particular assets. And that includes multiple visits, by experts across the spectrum, working the asset and doing full amounts of DD. So we haven't been able to do that at all really with the travel restrictions. Additionally, the gold price has had a very strong year and has rallied really from April through late July or early August, we'll say. And so generally in rapid gold price rising environments, you maybe won't see as much of that M&A because the sellers get a little bit greedy and they don't want to sell. And by the same token, the buyers feel that they're paying up in maybe a euphoric market and want to kind of hold back. And so we're in an interesting spot right here where the gold price is kind of consolidated here for the past 60 or 90 days. That to me is more conducive for M&A activity. And then additionally, travel is picking up, at least in the United States, but I think across the world to some degree, and it's gradually recovering. So I think M&A is going to pick up and continue, and that should be a tailwind for kind of the precious metal equity sector at large going into next year.
Yep. Okay. Adrian, do you have thoughts on M&A or perhaps how COVID's created a bit of a backlog in terms of this lack of travel, therefore the deal flow slowed down quite a lot?
Yeah, I mean, COVID has certainly caused a backlog because, as Matt said, obviously a company that's paying millions and billions wants to see the properties, and in many cases you can't do that, and you haven't been able to do that, and that's true of royalties as well. A royalty company making a substantial investment wants to see the project, and in some cases they can. One example, company just did a fairly substantial royalty in Australia. The head office team, the normal due diligence people, couldn't go, but they hired consultants in the state to go and look at the mine. So there's ways of doing it, but it's not the easiest. Picking up on something I think that Colleen said, just picking up and maybe going in a different direction. The industry is just not doing a lot of grassroots exploration. We need to do more grassroots exploration. I mean, brownfields is great, and it's the easy. I'll say easy. That's not quite. Gord probably won't agree with that, but it's the easiest and the least expensive. But we need to make new discoveries, and the seniors by and large are just not doing that, and it's on the juniors, and it has been for many years, and that's fine. There's no problem with using the junior sector as your sort of exploration arm. But what's a little bit surprising to me, certainly a little bit of concern, is that we haven't had more acquisitions of specific projects generated by juniors. Most of the M&A we've seen in the last couple of years has been, two intermediates or larger companies getting together, often on a no premium. But we haven't seen, big company A take over tiny company B because they like that particular project. And it strikes me that a lot of the companies are, apart from the COVID issue, a lot of companies, big companies, acquirers, have been preferring to wait until a project is more developed, until permits have been received, and they're more willing to pay up and pay significantly higher prices in order for a lot of the risk to be taken out. Because I think we can all think of examples in the last 10 years where companies have bought an exploration project that looks good and it hasn't quite turned out to be as attractive as it initially seemed. But I think that's the next stage we're going to see. And we have to see that. The big companies, you can only merge with other big companies so many times. There's some point where you've got to go out and find new projects or
But your
acquire.
assumption there is that the junior miners are open for business. And I would argue that a lot of them, the doors are not open for business, for M&A. They're still being rewarded for better putting out good drill holes. I mean, their share prices continue to appreciate. They're able to get capital. Most CEOs don't want to lose their job when they're able to.
You're absolutely.
It's a two-way street, I guess is my point. It's not just the seniors unwilling to enter. I think that there's an onus on the junior space to behave better as well.
No question about that. We could talk about that for hours. Some of the horror stories I've heard, people suddenly discovering change of control clauses that agreements that never actually existed, but they suddenly discover them in a safe. One CEO of a junior I know wanted a change of control that was equal to 4 times the company's market cap. I mean, basically saying, no, I don't want to deal. It's outrageous. Yeah.
Yeah. Okay, Gordon, let's bring you in. What's your view on M&A perhaps picking up, and could you give us some insight on strategies to replenish mine ounces? What's your take on grassroots exploration? Is it too tricky at the moment? Is it a good environment for getting out there and spending on grassroots?
I mean, a great discussion, by the way. I'm really, really enjoying it. And, we look at M&A a number of different ways, or growth in general in a number of different ways. When you're talking about single asset juniors and where they're at, certainly we have a portfolio of favorites. We tend to stick to the jurisdictions, at least generally, geographically, where we've been operating, because one, we know them geologically, we know them, from a government relations standpoint, we know how to operate in those areas. So that, we're not shopping all over the world. I think a little bit of the dearth of M&A, like others have said, M&A in the mining business isn't something you do with online shopping. You have to get on the ground and go see it. You're not going to spend that kind of money and understand the risks without walking on a project. I mean, I worked for several years as an engineer on major projects, and you can study the heck out of them, but until you get your feet on the ground and stand there and look around, you really don't understand a project. So that makes it challenging. Peer-to-peer, I expect there'll still be some more. There's a concern in the market about relevance. As an intermediate company, are you really a company that a generalist would even ever want to invest in just because you're insignificant? So trying to understand that. For us, because we sort of fought the trend, I think, over the past 7 or 8 years and did a lot of work on exploration. We didn't spend a lot of money. We were targeted. And when we go back sort of 2 or 3 years ago, I remember my predecessor saying, we just never get rewarded for this stuff. If you're in the mining business, eventually, hopefully you do get rewarded for it if you do well. And we have done quite well. But also at the same time, as we were trying to manage our budgets, we weren't filling the bottom end of the pipeline. About 3 years ago, we went back in and started to sign early option deals. I mean, we don't do absolutely fundamental generative grassroots. We will come in fairly early in a project, especially in areas we want to be invested in. And we've created that pipeline. You know, we have some interesting slides in our material that sort of demonstrates that. You know, with respect to where we're looking at M&A right now, I think is in support of our older operations. Is there something regionally that we can bring into the pie? We have gone through the brownfields part of the cycle there. And we have a pretty good feel, I think, generally for what's there. There's always a few more things to look at, but if we can find something nearby that we can synergistically bring into an operation, that's great and is useful for us, especially in the more mature plays, or in support of one of our existing projects and where we're at. What I find intriguing on the M&A side, you know, is when the big boys got together and the new Newmont and the new Barrick were formed, I guess almost 3 years ago now. All I could hear certainly from the investment bankers was, you know, there's going to be 20 assets from these two companies that are going to be on the block for sale into the market. And why would you explore? Why would you go develop anything? Intriguingly, maybe 3 of those have actually hit the market out of those 20. And I don't know if those big companies really will be looking to get rid of them, understanding everything we've talked about the lack of exploration over the past while, and them looking at their resource and reserve pipeline and wondering where those ounces are going to come from. Are they really going to spin out when they produce the kind of ounces they produce on an annual basis, and trying to replenish that, understanding that the prices are high? So the dynamics have evolved and changed over the past while. I think, like I said, for us, having that exploration pipeline as part of our business does set us aside a little bit. And then there's just, you know, the general vagaries of trying to make an M&A deal work. The peer-to-peer things are a challenge for a lot of the same reasons we talked about here. People don't want to lose jobs. Where is the actual value coming from? Are you actually improving the portfolio through the acquisition? What is the strategic rationale there? You know, you have to be very comfortable with it.
Yep. Excellent. Okay. Covered some excellent points there. We don't have too much longer, so I want to jump back onto ESG, which I know has been touched on throughout. Coille, why don't you take us through where you think the gold mining sits in terms of ESG standards compared to perhaps the rest of the mining sector? And also, could you let us know if there's any areas, not specifically gold mining or any companies in particular, but any reporting standards that you as an investor would like to see more of, or would like to see improved or picked up on by mining companies?
Wow, there's a lot to take in there. I think in terms of sort of ESG relative to, I mean, in the gold mining space specifically, I think it's varied. I mean, not all seniors or intermediates have responded the same way to ESG. I think it's hard to sort of group everyone together and say they're particularly good at one thing. I do think one thing that in general, though, that probably is lost on most people is their social aspect of ESG. I think, you know, we talked about CSR before, but that's sort of, I mean, mining by nature means you're going into a community and you need to develop relationships there, and those are long-standing relationships. And so CSR has sort of always been a part that they've had to do before ESG came around as a label. I think the area where I would like to see more improvement would be governance. I really struggle with sort of how comp packages are organized and sort of their peer groups they'd like to compare themselves with. I mean, no disrespect, the CEO pay continues to go up regardless of sort of share price performance, and I struggle with that, and I struggle with how much stock boards own, and so I would like to see more of that. And I think on the environmental side, I mean, mining is mining. I mean, obviously underground has a benefit, has a wins in terms of footprint, but I mean, there are a lot of companies that are doing great solar projects. I mean, B2s did a big investment in Namibia, so. There's areas that are working, but if I could pick one to have improvement, it would be governance across them. the market cap space.
Yep. Okay, that's good. Adrian or Matt, do you want to chime in with any of your points? Do you agree with Coille there that governance is perhaps something that's fallen a bit out of the spotlight, maybe for some of the other environmental factors that have been certainly the focus in the media and the headline stuff of late?
Yeah, I mean, clearly when there's an environmental disaster, that gets a headline, and so people focus on environmental, and we've had some unfortunate's a too kind a word. We've had some horrible things happen, in the last few years. But I think generally, a couple of things. I think generally the industry is doing a far, far better job, certainly on the environmental and the social. And companies that do not do a good job on either of those two do get punished. I mean, we saw that Tahoe in Guatemala couldn't get the mine Escobal, re-permitted and up and running, and they had to sell the company at a not particularly attractive price. And so, these things do matter in the end for share prices and share performance and returns. But I'll make two other points, if I may. With regard particularly to environmental and social, there are some people, and Colleen just mentioned B2, so I wasn't going to mention a name, but I'll mention, Clive is someone who Clive is someone who feels passionately about the environment, and there are other people in the business who feel passionately about the environment and feel passionately about treating other people from other cultures correctly. And if that's in your DNA, if that's the way you feel, you're going to do the right thing. And I feel the problem, I feel to some extent ESG has become a little bit of a fad. It's certainly become too bureaucratic and compliance oriented, meaning companies have little check boxes, some companies, and we run the danger. But instead of really doing the right thing for local communities, we just check boxes. Well, we held so many meetings this year, and we've got a good committee set up, and we have meetings once every quarter, and we've got a good file. And that's particularly true in my mind of governance. When we look at governance, we should be looking at some of the shenanigans that go on in the Vancouver market. It doesn't matter to me whether there's one woman on the board or the whole board is women. And I think that's probably true of everyone here. It just doesn't matter. And if we have a board that is all, let's say, white men, but they all have different experiences and they all contribute, I don't see a big problem with that personally. And I think sometimes this ESG becomes too much of a check the box and meet these particular criteria instead of, looking at, as I say, what's going on in Vancouver. That's governance or misgovernance that needs to be looked at.
Yep, I think Adrian and Coille both make some good points here. I would say that I don't think it's too controversial to say that ESG is as important as it's ever been. Maybe, as Adrian mentioned, it's kind of been taken a little bit, too far. The pendulum swung a little too far. But by the same token, local communities have more power than they ever have to hold up or stop a project, and that can be from increasing strength from NGOs that work hand in hand with local groups, and just something as simple as social media. It's easier to get bad acts out into the Twitter sphere and the internet and to gain attention. And so that's a big change in the industry just over the past 10 or 15 years. I think all companies are now paying lip service to ESG. I think you need to look on a case-by-case basis whether the companies are actually following through, or, as Adrian said, is more of a box checking exercise. I do feel, though, it's important to hire local in a lot of these jurisdictions. And again, you don't do it as a junior or a company just to say that you've done it. But I think there's actual key benefits to have. Thinking of Ecuador, which is potentially the politically charged jurisdiction globally when it comes to mining. If you can have key decision makers on the ground that speak the language, that have lived in the country, that look like the locals and live similar to the locals, I think that can make a big difference. Something as simple as that. And so I think hiring practices go a long way towards quality ESG. And yeah, from an investor perspective, it's important. It's definitely something we evaluate in our investment process. And it's nice that in a lot of cases, making money also lines up with being moral. Like, it doesn't help anybody's chances here to be pushing through a project that has no support to be built. And so your interests are aligned as an investor in that regard.
Yep. Okay, but they're all good points and very interesting insights to get the buy side view. But could I just play devil's advocate and say, certainly some of the pressure on ESG is sort of slowing capital coming into the mining sector. Obviously, it's an extractives business. It's very sensitive in that respect, and then the community side of it and the social, which we mentioned. But surely the big pension fund money, larger, more generalist capital would look at mining and say, oh, well, if these ESG criteria aren't met, then we can't put our capital into these funds that touch these projects. Do you see that it's holding capital back overall at the moment, and that mining companies have to be going through these kind of perceived checkboxes in order to prove more attractive? Or maybe it's an issue in the messaging, perhaps.
I think it's both. I think there's a level of maturing that needs to happen in the mining space in terms of, we talk about, the Equator principles and whether, you're following those and et cetera, et cetera. And so I think there's a bit of messaging that needs to happen. But I come back to my point about CSR. That's always been happening. It just has to be presented in a slightly different light. And I don't know what the number is exactly, but it's like $17 billion of ESG capital sort of been accumulated over the last few years. And, I guess I look at, people still want their iPhones and Teslas. So at some point you have to come back to extractive industries and say, well, who does it the best of that space? I mean, because I don't think it's a hard line.
Yep.
I think there's going to be some that win and get some capital.
Yep, certainly.
Or more about this in terms of what pension are asking, but that's my view.
Yeah, whether you like it or not, this is the direction the industry's going. So you can either whine about it, or as an investor adapt, and it creates both opportunities and can potentially hurt some companies, especially those with coal exposure or some of these other metals that are very much out of favor with society right now.
Yep. Could I just get Gordon's view here as the mining company? There's some of the ESG credentials that you guys are working on specifically at the moment, or some of the processes you've put in place over the recent years, not just necessarily towards COVID, but take us through some of your ESG responses.
It's intriguing, and the question has a lot of layers to it, and I agree. I think the mining or extractive industries in general are a little later to the game than other industries, and I think our own investors, for a wide part, a lot of them would have been challenged to understand what the term ESG made sort of 2 or 3 years ago. Some of them, and understanding that that's part of the investment criteria is great, and it's great to hear the others on this panel speak to that. There still are investors out there that you can see their eyes roll back in their head when you start talking about it. For us, as a company, thankfully, we've been working for over a dozen years with zero harm vision. IAMGOLD, in fact, owns the copyright on that term. We coined it many years ago, and it's a way, it's an attitude in how we operate. And we've been working at it for a long time, and that starts right from the first explorationist going into the field through closure. And you got to be talking to communities. You got to be understanding the environment. You got to be understanding how the government themselves manage ESG issues in the jurisdiction you're at. There's a lot of different aspects to it. For us, the recent growth in in conversations in investor circles has been relatively straightforward for us because we have the basis in place. The challenges we're seeing is one, the proliferation of standards. We adhere to some ISO standards. We're part of the Mining Association of Canada, so we adhere towards sustainable mining. World Gold Council has just initiated some new standards last year. So you're playing a bit of catch up, and you really do want to avoid that box ticking exercise. It's in pursuit of demonstrating that you know what you're doing, but a management system is not management. It's a system, and a lot of these standards just manage systems. The other challenge for us is the proliferation of ratings standards, ratings agencies. Every third email I get from an external source seems to be somebody saying, we've just created this new ESG rating profile. Can we get you to enroll in it? So it's going to take a little while for that to shake out, and that'll be quite interesting. At the end of the day, I think you just got to come with the right vision. Sustainable mining is around finding something, creating something that outlives the operation itself, that is created only because the mine was there in the first place. Something positive for the community, for the environment, for the country, whatever that is. It's not going to get easier. It hasn't gotten easier in my 35 years in the business. I think generally the current generation of miners is still living up to the legacy of some priors. Although, as Adrian said, I mean, there's been some absolute abominable disasters in the last little while of people not coming at it in the right direction. And the whole industry pays for that. I think it's just keep your head down and keep working and continue to be innovative. I think certainly the climate change issues, given the energy intensity of our business, will continue to be something we really need to look at. We're certainly looking at renewable sources of energy to power our mines as much as practical, or certainly at least less greenhouse gas intensive ways to operate. The whole industry is looking at that, and hopefully we continue to be successful in improving that way.
Excellent, thank you. A challenging period with constantly moving targets. So we're pretty much out of time, but if I could just keep you all for a little bit longer on my final point, I just want to be a little bit provocative here and ask you all, what's the value of holding gold mining equities now, and as opposed to looking at an index or looking at an ETF. If I was a big family office or an LP looking at funds, why do I want to go with an active fund manager at this point if I'm interested in getting exposure to the gold market in general? Coille, why don't you start us off on that?
Well, I mean, I guess one could look at performance track records. In our case, we consistently beat the index. So one, you can speak to performance, but two, when we just spoke about ESG factors and potential countries that you don't want to have exposure to or you're not comfortable with. I mean, when you buy an index, you're buying the best and the worst. So you're not differentiating. You don't get to express your views. With an active manager, we select. I mean, we run a concentrated portfolio of 25 names. So we're very comfortable with the names that we hold. So I think there's a difference of, there's a big, if you look at sort of the skew in terms of, even when the gold price rises, I mean, there's still always consistently underperformers, and there's, companies that outperform greatly. And it's not just the gold price that does that. So there's a huge opportunity for actual stock selection in this space. I mean, there's a lot of knowledge that you need to, or should know. It's not, not all companies are created equal. So there's a lot of options to ways to express your view on gold. They can't just with an index.
Do you think that there's still a lot of passive money still sitting in the wrong parts of the gold market and then waiting to move into equities, or are we going to see more of a flow?
Well, if you look at the year-to-date in 2019 GDX and GDXJ flows, I mean, it was out, down 1.8 billion last year, and I think we're at 600 million year-to-date this year. So you're still seeing outflows out of the indexes at a time when physical ETFs are at an all-time high. So there's clearly a disconnect from my perspective there. So I do think there's still some passive money sort of watching, and maybe not as comfortable just buying the index.
Yep. Adrian, do you have a view on some of those points?
Yeah, and I'm sorry, my computer just died. I had to restart it. Sorry about that. Yeah, no,
Okay.
I agree with everything Colleen said. Absolutely. I mean, first of all, you get to, stock picking, frankly, in any sector is important, but in the gold sector is probably as important as in any sector, because gold stocks are just about the most, let's say, idiosyncratic of any sector. You can have gold going up, one stock doubling and another stock going down 50%. So stock selection is one. The other thing, frankly, is that active managers allow you to get into parts of the market, but the indexes just don't. And I'm not going to pick on the GDX, but GDXJ juniors, it includes Pan American, it includes Goldfields, and we could list, the top 10 holdings are not, I can't speak for Colleen, but they're certainly not what Matt and I call juniors. So active managers enable you to get into the juniors, and also active managers, not only stock selection, but enables you to be a little bit more nimble. I mean, we're long-term holders, but it does enable you to be more nimble if the time, if the time is correct. And it's really funny, I'll just end on this if I may. I had a friend of mine ask me, this was back in July, and he asked me about, I think it's finally time for me to get into gold. What do you think? And I said, well, you've left it rather long, Fred, because we've been talking about this for a long time. And, I said why I thought the gold stocks were due for a correction. And he named 3 or 4 stocks to me. And I said, well, that's kind of high. I said, as high as cash flow multiple in 5 years. And well, this one's kind of high. And he said, oh, you're right. The stocks are expensive. I think I'll just buy the GDX instead.
Right. Yep. And you think that mentality is going to change much, maybe as we progress into next year and the gold sector evolves?
I think it will change as the market develops, as it matures, or develops is a better word, because I think we're a long way from maturing. I think a lot of generalists, I mean, let's be honest, if you're a generalist, you don't know much about gold, you think you ought to own some gold, and maybe gold stocks are the way to go. And you look at, I'm not picking on any companies now, but you pick on, I mean, you look at Newmont or Barrick, you say, oh, let's have a look at how Barrick's done. My gosh, the stock is 50% what it was in 2011. Let's go back to when the XAU started in 1984. It's hardly any higher than it was in 1984. A generalist is just not going to get past that, I don't think. So we need a few years of the stocks actually going up before generalists want to look at individual equities. Mm-hmm. And that's, of course, why the generalists are so heavy into the royalty companies. It's partly because of the business model, because they're getting exposure to a lot of stocks and it's a low-risk business model, etc. But it's also because as a group, they've actually performed. And so a generalist is a lot more comfortable with that.
And they haven't needed, I mean, you look at the gold price year to date, it's up 25%, and the GDX is up 30. I mean, you didn't have any operating risk. You're not that far behind. So until you get to a point where people view that they can actually make a lot more money by holding the miners, which should happen in due course. I mean, but we're not there yet. At least my perspective.
Sure. Yep.
Yep.
And
Okay.
Adam, I will say, I think Coille and Adrian have touched on the key points here. When it comes to physical gold, I won't shy away from recommending that to individual investors as a wealth preservation asset. In the United States right now, your average investor has less than 1% of their overall portfolio exposed to gold. So even a 3, 4, 5% physical weighting can give investors massive legs up on the competition and some pretty excellent insurance in the portfolio that's being overlooked. Of course, this number's been bandied about, but in the 70s, I think we got as high as 7 or even 8% of your average U.S. Portfolio was exposed to gold equities. I don't think we're going to go back there in anytime soon, but even some amount of reversion to the mean is going to result in big inflows to the space. So physical gold, I'm happy to just say generally this is a good place to be. You don't need to bet the farm, but some exposure here gives you a big leg up to U.S. investor, or to your average U.S. investor. When you talk about gold equities, just generally, like I'm very leery to recommend that. Like the gulf between the best and the rest is massive in this space, as Adrian has flagged. And like I think to harp on this point, like Pareto's law is very, very alive and well in this industry. And especially if you look at the junior side of the market, I don't think it's a stretch to say that literally 80%, if not more, of those companies are entirely uninvestable under any circumstance. And so for me, unless you have extreme experience in this space, I don't like saying to investors, oh, you need to get involved in gold stocks and leave it at that. Like, I think it's much smarter. And of course, I'm talking my own book here, but to put the money in the hands of active managers like myself or Adrian or Coille, who can really sift through hundreds, if not thousands of opportunities. And you kind of pick a portfolio of 15, 20, 30 names that are going to do best. So I think it's insanely important to be selective in this industry. It sounds cliche, but if you just look at the market over time and share price returns, that's the only conclusion that you can come to.
Yep, absolutely. I think that's a great point to end on. It's a highly specialist field to be in, and we've heard some excellent insights from everyone there about how we're viewing it and how to invest in the space. So I'd like to say thanks very much to my panelists, Coille, Adrian, Matt, and Gordon. Thank you very much for your time and an excellent discussion there.